Yes, the pace of the rate cut may slow, but I wouldn't be too concerned about it. We're still looking at fairly strong economic growth, and we're still looking at an ongoing rate cut cycle. And this combination typically is an ideal backdrop for risk assets, even if the rate cut cycle is slower than previous expectations.
Alrighty, so this week has been extremely interesting. Lots of fundamentals and lots of things shaping the market landscape. In today's breakdown, I really just want to give you guys a more detailistic perspective on why risk assets across the board are relatively bullish. Primarily, our focus is on cryptocurrencies. But the reason why I like to do this for you guys, doing these fundamental digests throughout the entirety of the week, is to not only keep you guys in the loop, playing chess with the markets, giving you all a retail advantage, because the vast amount of retail traders out there, they don't pay attention to this stuff. But it's so that way you guys don't think false profits are driving market sentiment. And I'll go over that in just 1 second. So there's things that the retail side of the crypto markets cover via the fundamental backdrop, and they make it seem like that's what's supporting risk assets. And I'm not saying that those fundamentals aren't driving market optimism, because they most likely are to some degree. But if you were to go into a major hedge fund or a major financial institution, and like, let's say the United Emirates, or like somewhere overseas in the Middle East, or even in Europe, or anywhere overseas, and you go into like a major asset management firm or hedge fund or large institution, and you say, hey, the cryptocurrency markets are bullish today because Gary Gensler is resigning, they're literally going to look at you and laugh hysterically at you. That is not why these large asset managers are buying up cryptocurrencies and buying up risk assets and shifting capital allocation from safer haven plays to riskier assets. It's much deeper than that. So that's why I like to scratch the surface on these fundamentals. I'll sit here and I'll read for 2 or 3 hours all these fundamental reports to digest and pick apart key vocabulary for you guys to then type out our report. And then I send that to you guys. And hopefully you all have benefited from understanding these fundamentals a little bit deeper to kind of digest risk on, risk off market sentiment. So we'll get into that a little bit today, dive into why the markets have been bullish, because there are a lot of things supporting risk assets outside of just Gary Gensler resigning from office, which is literally like the only thing that I see on Twitter and YouTube right now, especially amongst XRP enthusiasts, as to why they think the market is bullish. But that literally is playing like probably less than like a 5% role in why risk assets are bullish, probably even less than that. All right. Right off the bat, just to give you guys some DCA updates, in this Zoom call that we had 2 days ago, we talked about specific assets that I was looking at the time. I think I had like $3,000 of capital to dump into the markets, and I facilitated across the board. I talked about ICP, LCX, Algo, Velo, and Flare. Those were my primary focus in this specific Zoom call, and I told you guys that. And then today, looking back, ICP is up 15%. LCX was the top performer. I wish I would have plugged a little bit more money into LCX. I think I only put like $300 or $500 in there, but that's up 25% today. Algo's up 15%, Velo's up 10, and Flare's up 9. So not too bad considering the DCA callouts that I gave you guys. Always just showing you guys that we like to buy when markets are slightly pulled back. In that Zoom call, I pretty much talked about how those specific assets hadn't seen a significant rally yet compared to like XLM, XRP, soy, so on and so forth, right? So that's proving to be beneficial. Hopefully, if you guys listened to that Zoom call. Again, it's not financial advice. I just like to tell you guys how I'm building my portfolio and why I've been consistently profitable and what I pay attention to when I'm plugging capital into the markets. All right. So I just wanted to update you guys on that. Moving on. So here are those retail fundamentals, right? We can see Bitcoin rises after the SEC chair says he is to step down when Trump is inaugurated. Like I said, if you took this article from The Guardian into a major financial institution in like Dubai or something, they literally look at you and be like, do you think we give a fuck about Gary Gensler? Do you think we care about what this dude does on a daily basis? Heck no, we don't care, right? So this, at the end of the day, you have to think more logical, is not the only reason why risk assets, the entire cryptocurrency market is relatively bullish right now. It's so much deeper than that. This is just surface level stuff that retail pays attention to distract and orient their time, and in my personal opinion, waste time. Okay. Here's another retail surface level article that I feel like distracts the mainstream retail traders from thinking why the asset class that we trade is bullish, when in reality, this has like, again, it's probably driving some optimism, but if you were to take this to, a large scale financial institution intraday where they're facilitating capital and shifting liquidity around from certain asset classes, they'd probably look at you like you have a freaking bug on your face. Trump's potential pick for ICC chairs detailed three-step plan to end war on crypto. Yes, this is super optimistic for the forward outlook of crypto, that I'm not denying. But this is not why larger investors than you and I that actually move these markets are shifting allocations into crypto on a global scale. All right. This obviously, of course, like I said, can play a role, but it is not the main role like the mainstream media and Twitter and YouTube make it out to be. Okay.
Yeah, indeed. And the first point actually that I would like to make on this is that expanding global liquidity has been probably the strongest driver. In fact, I would say clearly the strongest driver of bull markets in recent times. And I don't just mean the crypto market, I mean financial markets in general, and especially since 2008, the financial crisis. Basically, asset prices are increasingly shaped by what previously would have been termed unconventional central bank policies that basically directly affect liquidity conditions. And these have actually increasingly become the dominant force in moving asset prices. There's actually this cliche term now, I don't remember who said it first.
So these are the two primary drivers amongst the retail mindset that I saw today as to why they think the crypto market is up over $1 trillion freaking dollars this month. Like literally, we're printing historical candlesticks right now. I don't know if you guys know that, but the market right now has 8 days left to close for the monthly candlestick. And if it closes above $3.2 trillion in market valuation this month in November, it'll be the biggest monthly candlestick close in crypto's history, gaining over $1 trillion in market value in 30 days, which is insane. What a time to be alive, right? So let's go through this report. I just put this in the chat if you guys want to read along. So these are after reading, literally. I mean, you guys should have seen all my tabs this morning, maybe one day too, because somebody asked me in the chat, how I write these fundamentals. I think I did a brief Zoom call this week where I broke down GBP USD, and you guys saw I had all my tabs open and I picked apart different vocabulary words and certain sentences that I pay attention to. That's how simple it is. Yeah, it takes time and it takes some practice, but that's what I do for you guys when I write these reports. I literally have 20 tabs open and I digest and read different fundamentals from different news outlets and sources. And then I put it together in an easy, understandable way for you guys to digest the data without having to sit down and do the hours of research that I do. So that way it's just faster for you guys to retain this information. Okay. But maybe in the future, I'll host a Zoom call where I just literally start the Zoom call from the beginning of writing out the report to the end, and you guys can just see the process that I go through to skim through the data and the fundamentals that I read. So November 22nd, 2024 update. Why risk assets are bullish from a more detailistic institutional perspective. So despite geopolitical and macroeconomic headwinds, which we obviously, of course, saw an increase in an uptick this week with the Russian-Ukraine conflict, although I already said to you guys in previous calls, I personally believe because of the market reflection that we had this week where the Russian-Ukraine conflict escalating did not have a negative implication in crypto and risk assets abroad. I personally think that other macro drivers driving bullish sentiment to and towards risk assets is still the remaining factor because the Ukraine-Russian conflict, having gone on for 3 years, is already priced into the markets. Realistically speaking, the only thing that would weigh on risk sentiment from a Russian-Ukraine conflict perspective is if another major jurisdiction indefinitely got involved, like 100% guaranteed got involved. For example, the United States providing warheads or whatever it was, missiles to Ukraine. That's nothing new. The United States is one of the biggest military industrial complexes on this earth. They're always supplying rockets and ammo and bullets and tanks and all this shit to jurisdictions all over the world. That's not breaking news. Like that's nothing new. If you know anything about the United States, that's like one of the main things they're known for. So when I saw that article trending, I was like, man, this isn't going to have any negative implication. That's when I told you guys in the chat, like, when everybody was talking about World War III just started because the United States supplied missiles to Ukraine, I was like, no, that's nothing new. Um, and that was obviously, of course, correct to be the case. So the only thing that would escalate that scenario further is if we like 100% confirm that like Russia was gonna directly attack the United States because of that. That would obviously, of course, escalate things further and create some new fear, uncertainty, and doubt compared to what's already priced into the market. So for now, that's nothing that we have to worry about. Be on standby for that, as we already know that the weekend tends to bring escalations in Middle East tensions and possibly the war in Ukraine. That's just something we have to be on standby. Risk assets, including equities and cryptocurrencies, have shown remarkable resilience and growth despite ongoing geopolitical tensions, as I mentioned, and potential monetary policy shifts. The cryptocurrency market today alone added $30 billion in value, capping off a historic month with over $1 trillion in inflows, marking the largest monthly candlestick close in crypto history if, again, we close above $3.2 to $3.1 trillion in 8 more days. So here is a breakdown of why risk assets continue to rally in such an environment. So number one, robust U.S. economic activity and signs of continued cooling inflation. Without reading the remainder of this report, I'm just going to ask you guys a question. Robust economic activity combined with continued cooling inflation supports a what? It's a 2-word key vocabulary phrase that we know tends to benefit risk assets. What is it?
Rate cut.
Okay, rate cuts. Good job, Camille. Yes, rate cuts are still on the table, but that's not the vocab I'm looking for. But good job.
Risk on.
Okay, risk on, not quite. It's right here.
Carry trade. The Japanese carry trade.
Soft landing.
There you go. Who said soft landing? Cedric?
Yeah.
Okay, so remember, economic stability or an increase in economic activity combined with cooling inflation supports a soft landing. Now, none of you guys were incorrect via the vocabulary that you said, but just particularly pertaining to the question that I asked, I was looking for that vocab word. So number one of the main reasons why we're still seeing inflows into riskier assets is because we're seeing robust U.S. economic activity. At the same time, we're seeing continued signs of cooling inflation. So here is the PMI figure and the inflation expectations that came out today. U.S. output growth accelerates as business mood brightens and inflation cools. Here you guys can see it reads, Flash U.S. PMI survey data signaled a marked upturn in growth of business activity in November to a 31-month high, with output strengthened by the sharpest rise in demand for a 2.5-year and improved business confidence. Firm expectations of output in the coming year rose to the highest since May 2022, attributed to the prospect of lower interest rates. So like I said, Camille, good job. You're still paying attention to key vocabulary. We know that a lower interest rate environment or prospects for a future rate cut or a lower interest rate environment tends to benefit riskier assets. Improved economic growth and more supportive business policies from the new administration in 2025, that's Trump. Employment fell for a 4th successive month. We know that lower employments, obviously, of course, supports further rate cuts, while output price inflation also cooled to the lowest since prices began rising in June 2020. So we're still seeing robust economic activity combined with lower inflation. These figures indicate a robust expansion in the services sector, which offset continued weakness in the manufacturing. I said here, the sharp rise in new orders and improved business confidence are key indicators of economic resilience, with expectations for future output their highest since May 2022. Soft landing implications. The data signals that the U.S. economy is navigating a soft landing, where inflation cools without triggering a significant economic contraction or recessionary fears. Cooling price pressures and renewed optimism in manufacturing suggest broader-based growth ahead. A soft landing, we know, supports a risk-on environment, encouraging investment in equities and cryptocurrencies as recession fears wane or weaken, right? So that was number one. After reading all the reports today, gathering all the information for you guys, a lot of the reports were talking about a continued soft landing, optimistic perspective that inflation is going to continue to come down and cool, while business activity and economic activity is going to remain relatively robust, especially for the United States compared to other major jurisdictions. Number two, was the Federal Reserve policy stance. Rate cuts still remain on the table, albeit the percentage chance of the expectation for a December rate cut has slightly dwindled from previous expectations. It is still expected. So this week we had commentary from Federal Reserve speakers. It was like a whole freaking handful of Federal Reserve speakers. All in all, the market took what they said and still priced in December rate cuts, which, just like Camille said, is one of the things that supports a further risk on market environment, particularly in equities and cryptocurrencies. Despite hawkish caution from some Fed Reserve speakers, markets are still pricing in a 55 to 60% chance of a December rate cut. Fed speakers, including Susan Collins and John Williams, hinted at the potential for reduced rates, emphasizing the need for careful collaboration to sustain growth without reigniting inflation. Here you guys can see direct screenshots from some of the reports where I gathered that information. Fed December rate cuts back on the cards. Here it says, yesterday we had FOMC members speaking, and one would think that perhaps they might move the markets to the downside, but this was not the case. Then here it says, Fed Collins says more rate cuts are needed. Federal Reserve Bank of Boston President Susan Collins said on Wednesday that more interest rate cuts are needed. So all of this supports future rate cut prospects from the Federal Reserve via multiple Fed speakers. All right, so that was number two. We're still seeing a supportive rate cut environment, which we know tends to benefit risk asset investments as markets start to price in the future prospect of lower interest rates from multiple central banks. Then, this was probably one of the biggest factors that I've seen nobody on the internet talk about, and that is stimulus measures this week that were announced from both China and Japan. If you guys go back to 2020, 2021, we know that major central banks all over the globe were doing what? They were in a quantitative easing cycle, right? They were pumping out economic stimulus because of the economic turmoil that we experienced due to CV-19. Well, yet again, we're starting to see major jurisdictions, particularly in this case, China and Japan, announcing stimulus packages, and we know what that tends to do. Okay, so this week we saw China boosting economic recovery, stimulus measures targeted at the property sector and broader economic recovery, continued supportive policies, including fiscal spending and reduced borrowing costs. Here is a direct link to the article from November 20th that I read about this. You guys, I would obviously, of course, recommend you do the same. This is a clickable link. You guys can go and read, but it says here, Asian stocks rise on China stimulus cheer tech strength, right? So we know stimulus measures tend to boost risk asset currencies or risk asset classes. Okay. Then not only from China do we have stimulus measures announced, but Japan also announced $250 billion economic stimulus. Japan approved the comprehensive stimulus package to boost income, support digital innovation, and alleviate energy costs, tax reforms, including cryptocurrency tax cuts, further incentivizing investments in risk assets. And here is a direct report on that. So economic stimulus packages and risk assets. We know that economic stimulus injects liquidity into the economy. It spurs consumer spending and boosts corporate earnings, which directly benefit equities and other risk assets. For cryptocurrencies, supportive policies also from Japan and tax reforms in major markets signal increasing adoption and investment flows. So we had some announcement. I don't remember where the link is. It was a Cointelegraph link. I'll find it for you guys and I'll stick it in the Discord. But long story short, there was some type of tax reform that was being announced via the Japanese finance ministers on taxes that Japanese individuals are going to have to pay on their cryptocurrencies, which was also supportive of a risk on market environment. Okay. Like I said, I'll drop that in the Discord for you guys, or maybe I'll just find it again and I'll add it as an addition to this report. All right. So that was number three. We had stimulus measures from both China and Japan announced this week, which again, like I said, if you go look on Twitter right now, if you go look on YouTube, nobody's talking about this. Not one single retail investor in the XRP community probably even knows that this happened this week, which is another major driving factor that is, again, pumping liquidity into riskier assets. Okay. So you guys, as we're going through this report, can start to see my reports compared to the mainstream retail mentality that just thinks that Gary Gensler's pumping the markets right now. It cracks me up, man. All right, number four. This is another big one. Like probably one of the big key factors driving risk sentiment is global central bank positioning and central banks moving forward, like the ECB and Bank of England, expecting future rate cuts. So not only are we expecting future rate cuts from the Fed, but we're also now, after this week, expecting future rate cuts from both the ECB and the Bank of England due to weaker data. So from the ECB, markets are increasingly pricing in a half-point rate cut in December, driven by weak Eurozone PMI data. This reflects slowing business activity and economic challenges within the Eurozone region. The Bank of England, similarly, the Bank of England is expected to ease monetary policy as UK business activity this week slowed. The anticipation of rate cuts highlight a shift towards a more accommodative stance to support growth. And here are some of those fundamental pieces and screenshots that I read this morning to gather that data. As you can see, the headline reads, rate cut hopes drive UK stocks higher after weak economic data. This one reads, European and UK stocks jumped the most in months on ECB rate cut hopes. So yet again, we see this prospect for future rate cuts, the market starting to price that in. And what does that do? That boosts risk assets globally, not only European stocks, but UK stocks. We're also seeing Asia stocks rise on Chinese and Japanese stimulus. And obviously, of course, cryptocurrencies are global, right? Where any market participant, no matter where they're at in the Eurozone, the UK, or in Asia, can participate. So if global stock markets are bullish, then what is that most likely going to reflect via risk assets? And crypto is also going to be bullish. Okay. So that was number 4. Number 5, I just talked about the positive sentiment in the US, right? Obviously, of course, we got the Trump potential pick for possible SEC chair. We got Gary Gensler resigning. So I added that in the report, right? Possible positive US regulatory environment, of course, drives optimism to this market. And that's relatively speaking it for what it is that I found this week driving sentiment towards risk assets. So all in all, we have the expectation for lower interest rates. We have increased adoption and favorable regulatory developments. We have, obviously, of course, the outlook for future rate cuts from major central banks, stimulus injections from large jurisdictions like Japan and China. Okay. So all in all, these are the factors this week as to why we're seeing a continued inflow into risk assets like cryptocurrencies. Now, just because we are extremely bullish, we still need to be on our toes just in case the sentiment starts to dwindle. Obviously, of course, I included what those risk factors would be. The primary factors are any central bank shift in monetary policy. So if we start to see any upbeat data that starts to weigh on rate cut prospects, which now you guys have seen are clearly driving a risk on sentiment, either from the Bank of England, the Federal Reserve, possibly even the ECB or the Bank of Japan. However, from the Bank of England, the ECB, right now, I'd say that they're confirmed going to see a rate cut in December. Fed still kind of on the teeter-totter on what it is that they're going to do. We definitely need to be data dependent. We need to see how the unemployment rate and the NFP report comes out in December. And then we also have another inflation report before the next Fed meeting in December that we also need to pay attention to. From the Bank of Japan, we definitely need to be mindful of any uptick in data that we might get as we head into December. For the Bank of Japan meeting, any uptick in inflation or any upbeat data that might raise caution that the Bank of Japan could hike interest rates. I shared a Bank of International Settlements podcast with you guys where they directly discussed and talked about the Japanese yen carry trade unwinding. It was kind of hilarious listening to it because I literally felt like I was in a Zoom call recording with myself, because they literally just talked about exactly what we're talking about now. Central bank positioning, global risk, like the liquidity provisions that a Japanese yen carry trade unwinding could have negatively affecting global markets. All stuff that we cover in the private community, right? Number 2, geopolitical risks. Obviously, of course, these are things that we can't necessarily predict because there's no dates involved. They kind of just sporadically happen. We know Middle East tensions are the primary factor that could weigh on risk sentiment. Any escalations via Israel and Iran or any other major jurisdictions getting involved. And I already explained to you guys the Russian-Ukraine conflict. I think that I think it's priced into the market. If we see any other major jurisdictions or announcements of Russia expanding its attack to other jurisdictions, then I think it could escalate and weigh on risk sentiment. But for now, it seems that anything via the Russian-Ukraine conflict is priced in. And then any macroeconomic surprises, like any inflation from other major jurisdictions increasing, or showing signs of sticky and troublesome, any energy prices rising, any economic slowdown or extreme turmoil in any other major jurisdictions that spark recessionary fears are all just continuous factors that we need to be mindful of, right? So outside of that, after this breakdown, you guys should now know why we saw $30 billion, particularly today, pumped into the markets over the course of November. We've been covering this stuff. We're all awake and aware as to why we've seen a continued risk on sentiment, and we know what to be mindful of moving forward. Next week, we have a very busy week. We don't have any data on Monday, so we probably won't have a Zoom call on Sunday. Our first Zoom call next week will probably be Monday evening. And then don't forget, next week here in the United States on Thursday and Friday, I believe, are bank holidays with Thanksgiving and Black Friday. I don't know what I will be doing with family and whatnot. So obviously, of course, just be mindful of the Zoom schedule as we head into the holidays. Obviously, of course, as we roll back into 2025, after the holidays are kind of over, the regular Zoom schedule every single week and covering fundamental breakdowns and whatnot will obviously, of course, pick back up. All right. So outside of that, that's it. That's all I have for you guys for the economic report and the fundamental macro backdrop as to what's driving risk on sentiment. Just be mindful as we progress throughout the weekend. If you guys are ever concerned, don't be greedy. It's okay to separate portfolios sometimes as well. Like I have an intraday portfolio that I try to take profit on. I have a long-term portfolio and I have a DeFi portfolio, right? I don't suggest that you guys do the same, okay, because I can't give you guys financial advice. But if there's ever a part of you that wants to take profit in market cycles like this and you want to make immediate gains and whatnot, then start to consider separating your portfolio, where portions of your portfolio you just have that you never touch and they sit in your cold storage wallet and you don't do shit with them. Then maybe you have a certain portion of your portfolio that you sit on exchanges that's hot and liquid and ready for you to take profit, right? So on and so forth. Think about different strategies to pay yourself in these markets. But then with that money that you pay yourself with, don't just allow it to sit in your bank account. Utilize DeFi, utilize stablecoins, utilize other investments in the digital asset space to earn yield and constantly grow and maintain your wealth. All right. Outside of that, I think that's all I got for you guys. I'll leave the floor open for just general talks and comments. But yeah, many blessings to you guys. This week you freaking killed it. Saw some really good comments in the chat, saw some really good journal entries, saw some really good phenomenal trades. Some of you guys in the institutional scalper order flow section are freaking killing it in the futures markets. You guys also in the GBP USD chat today, or pretty much all week, were freaking killing it. Yeah, I think that's all I got. We had a freaking phenomenal week here at CYPRX. Yet again, accuracy across the board, logical target areas, lots of targets came into fruition on XRP that we were calling out weeks in advance back when we were buying at 49 cents when everybody else was fearful. So it's been an extremely good week and an extremely good month so far.